Welcome, everyone. It's the weekend. I hope you're all having a great Friday. I wanted to jump in and do a quick Questions for Joe video. If you're not familiar, this is where I answer your questions on the Questions for Joe channel. So if you write a question here, try to write like a specific question that I might be able to give you some input on, and I'll give you the best answer that I can, but I have not done any previous research on any of these questions. So this is just completely off the top of my head. It's my hot take or whatever on anything that you ask about. Now, let's go ahead and jump right into the most recent ones. We have Blue Collar Hustle. You're asking about ETFs here. You say that I chose SCHD, VYM, VIG, and HDV. And I'm already holding ESPO, WCLD, and IGV. A lot of these dividend ETFs have overlapping companies. Do you think this is too many ETFs to be holding in my portfolio? Blue Collar Hustle. I do think that that's too many ETFs. SCHD, VYM, VIG, and HDV are kind of the same with minor differences in how they weight things, how they control for risk. The way that they function is slightly altered, but I would just pick whatever one you like best. Because what you're doing is you don't really have a strategy. You're taking 4 separate strategies and just kind of mushing them together in this, in this ball of different strategies. And you're not going to really what are you trying to get out of that, right? It's not going to hurt anything, but you're not really sticking to any type of strategy that has it's not going to give you any type of edge. So with these dividend ETFs, I would just pick whatever one you like the most. That's what I would do. The growth ones, those give you exposure to all different things. So you don't have to change those ones around. Dave N says, Joseph, a potential CEF for you to look into is STK. It has a higher expense ratio, but it appears to generate better overall returns than SCHD, and it's better income than QYLD per my back. That's a lot. Better income than QYLD. I don't know if I feel comfortable with that. I think anything that has above a 10% yield it's a little extreme, I don't know. I don't know enough about that to feel comfortable investing in it, but I will look into it. STK, so far I have made no investments into any closed-end funds, but I'll take a look at it, Dave. Sunshine says, hey, Joseph, I have a question about books. Okay, this is a long question here. I'll try to summarize some of it here. When reading books of value investing and fundamentals, maybe even reading Dr. Michael Burry, his recommendation list, and looking through finance in general, how do you pick out information? How do you determine what's relevant and what's not? I would like some insights as to how to select a book to read, pull valuable information from the book, remember what you read, and apply what you read. And then this is Michael Burry's recommended list, right? Yeah, so I don't know how much I can help you with all of this, but I select books to read that I think I'm going to get something from. I'm going to be inspired. I'm going to be motivated. I'm going to be enlightened from it. And a lot of those books that I get that reaction from, I try to recommend to others. Like ones from Peter Lynch are incredibly motivating, inspiring, confidence building. Those are the type of books I like to read. I also just like good stories. So like the one about Bob Iger that I've read, him being the CEO of Disney, or the one about Bad Blood and Theranos by John Carreyrou, right? About Elizabeth Holmes and how she started off as wanting to start something great and kind of turned into a fraud halfway through. Those are incredibly interesting books and great stories, and they're real, they're relevant, that it gives you insights into the world of business and startups. That's the type of stuff I like to read about. So if I want to just learn about investing, I'm probably not going to go and dive deep into a book, but if I want to learn principles and things that can teach discipline and different insights of thought that you don't really get just reading random information on Investopedia, there's books for that. So Howard Marks has a lot of books that I think give you a good look into in-depth thought. Those are ones that I'd recommend. And then I'm sure Michael Burry, he has a good set of books here because this guy's interesting. He knows a lot, and so I'd look at his recommendation list. The ones that Intelligent Investor and Security Analysis, very dry books. I don't recommend them. I think they're too boring and too dry. Personally, I almost have the attention span. I could barely get through these type of books. I think there's some other ones in here that might be a little bit more interesting. But yeah, that's my thoughts on it. Just find whatever inspires you and motivates you. Don't waste your time with stuff that is not either incredibly entertaining or it's not putting you in a position to go out and accomplish more. Just don't waste your time with it. Duck Blast says, hey, Joe, I asked this question in general. I remember this question. You send out a Google form poll, restricted to one per user, list off all of their holdings, weigh each one, and essentially have an ETF list of Discord members' holdings by weight. Duck Blast, I know this question, and there's actually an easier way to do this. If everybody puts their portfolio into Qualtrim, I have a nice database of everyone's portfolios. And with a couple queries, I could easily anonymously gather up the top holdings and the percentage of every one of them. And then I could actually see the entire portfolio of our Discord. So what that would require, though, is everybody entering in their updated holding information into Discord. And then I could make that into a big portfolio. I could show the entire portfolio of the Discord very easily without using Google Docs. Not even worrying about that. Okay. All right. Spoiler here. Risky click. We did it though. Noel plus 10K says, hey, Joseph, do you think having multiple income funds, this is what I have currently? Same answer as the person further down. You're just kind of meshing strategies with this many dividend funds. A lot of overlap. You don't really know how much you own of one company. How much Coca-Cola do you have in there? You don't know, right? You have too many ETFs. There's no insight into it. So you're just meshing together strategies. It won't harm anything. You're not going to necessarily lose money because of this, but you're just invested in a lot of things and you don't really know exactly what. So I would just try to have every ETF serve a unique purpose. If you want to invest in dividends, I would have a dividend ETF. If you want to invest in growth, I would have a growth ETF. If you want to invest in growth plus have extra exposure to esports, then I'd invest in a generic growth ETF and then layer on an esports ETF. You see what I'm saying there? Then they serve a purpose. Then you have a growth ETF plus an esports one. Or if you have a growth ETF, but you want a little bit of extra exposure to cloud computing, then introduce a cloud computing ETF. So those complement each other. Those work together. But just having like 3 or 4 ETFs that are all just broad-based dividend ETFs, they're not really complementing each other. They're just kind of overlapping each other. So that's my advice. It's fine having 5 or 6 ETFs. Just make sure that they give you exposure to different factors that you're wanting or different industries, that type of thing. So I think it would be fine to have a dividend ETF, but then if you want extra exposure to like real estate, then you introduce a real estate ETF or something like that. But I wouldn't just have a bunch of different dividend ETFs because you're just kind of muddling things at that point. I skipped over a couple questions here. Dave N again says, what do you use to manage your content planning for your channels? I just use Notes, text editor. I have a bunch of ideas of different videos and then I fill in things as I see things for them, and that's basically it. I know you're thinking that that's incredibly unorganized, and that's usually it. I'm not that organized of a person, I've realized. So what you see in the videos is after me just piecing stuff together, but it's really, there's no huge, grand, organized thing. That's probably something I could work on. Poor Boss says, am I ill for considering what might happen if I dump the majority of my investing fund into JEPI? I'm talking about the vast majority, 75%. It's better than, there's nothing wrong with JEPI, but you want to have ownership. And JEPI is reliant on a strategy of a couple fund managers running this covered call strategy. That's great, but I would prioritize having ownership. I'd make that the bigger portion of your portfolio is owning a lot of companies, just having pure straight equity in them. Because I think that will ultimately generate more wealth than even JEPI, in my opinion, down the road. JEPI's fine. I have 20,000 in it, so I think it's a great covered call ETF. It gives me supplemental income on a monthly basis, which is fun. But I personally, if you're asking my opinion, I wouldn't put 75% in it. I would put a smaller portion into JEPI. And then I would buy, if you want like income, I would buy a little bit lower yielding ETF like SCHD or something around that style. Maurizio says, hello, Joseph. Hope you're doing well. Yesterday, I asked you how to how to see the purchase price from your portfolio because I started investing and I have 200K. Where would you invest if you could give me a guide to create my portfolio? Maurizio, I can't create a portfolio for you. There's too many, what I pick out might not be the best thing. It might not be the best performing thing. You're going to have to research where you want your money to go, what you want to own and where you see the future going, what you think will have the best risk adjusted return. My generic advice is if you're asking somebody else to pick out investments for you, I think that means you should probably start off with at least 80% of your portfolio in broad-based ETFs like SCHD, SPYG, those type of ETFs. Those are very kind of generic cookie cutter ETFs that get you invested. And cookie cutter is not a diss. Cookie cutter just means it's just easy. It's well tested, well proven, has a great history, and it will most likely, based off of every bit of information we know, do well in the future. So SPYG is an excellent growth-centered one that will give you exposure to a lot of leading technology firms, which I think is important to some extent. And SCHD is a proven one that invests you in a diversified, well risk managed portfolio of companies that have high amounts of profitability at low valuations. So SPYG, SCHD are two that I think are fantastic, but I wouldn't just completely take what other people are doing and invest in them. That's my advice. I'm going to give insights and continual updates on what I'm investing in, where I'm putting my money. And some of those don't turn out good. Most of them luckily have so far. Most of them have done well. The biggest ones that I placed my biggest bets on, like Apple and Disney and JP Morgan and Store Capital, those ones have turned out okay. But you can see that there's been some that I've had a rougher time with. I almost lost some money with AT&T. So that one, if I didn't sell the same day, then I would have lost money. But yeah, I can give you my holdings page, but I don't want you to just go and copy it. All of them I bought at different price points over different periods of time. If I were you again, my advice would be stick with broad-based ETFs to build out the huge foundation of your portfolio. And then as you get more confident in investing and doing individual security analysis, then you can start layering on your individual bets. As if you have a unique insight into a company that you have reason to believe it's going to be more successful, that you have a good risk-adjusted return with that company, you can put extra emphasis on it. And I'll give you my opinion on it, on different companies that you send and stuff, but that would be my advice. If you have $200,000, that is no small chunk of change. You want to put that in, build a foundation first, and then as you become more confident in doing the analysis and work yourself, you can start making these individual bets. So just message me directly and I'll send you a copy of my holdings page. That way I'll be reminded because I might forget after this. Simon says, "Hey Joseph, hope you're doing well. I asked this question further up in the channel, but I hope it's okay to ask another. Will you ever do a podcast? I know I would love it at least. And if you are thinking about it, would it be solo or are you considering having a co-host?" I haven't thought about it to that level. A co-host podcast. Yeah, the answer is right now. Right now I have the 2 channels, plus I have every once in a while I do exclusive episodes or little video updates like this. I haven't thought about a podcast, but I think it would be a lot of fun. And I do think it would be fun to kind of do a thing with maybe some other YouTuber personalities or something like that. I would have fun doing that. So I'm not ruling that out. I think that'd be a really fun way to do a different format of content. It's just a matter of putting it together. I've been doing more and more content as time goes on. So I think naturally down the road, a podcast will probably be a thing, is what I'd say. X31 says, what's the point of investing in a company like Verizon when there's pretty much zero capital gains when there's ETFs like JEPI that pay higher dividends and has some sort of capital gains? Well, Verizon has had low capital gains, but it hasn't had none. And Verizon is a company that Warren Buffett's buying a lot of right now. He just bought $8 billion of it, right? Warren Buffett knows JEPI exists, but he chose to put his money in Verizon. And I think because Verizon, I can't remember the stat on it, but I believe Verizon has enough cash flow to pay for itself in like 5 years, which is pretty incredible, to pay for its entire market cap in 5 years. Not many companies can do that. So Verizon is a high cash flow business, and what you're looking for there is stability. When the markets come tumbling down, JEPI will probably fall quite a bit because it's diversified S&P 500, but will Verizon fall quite as much? Probably not. It might fall a bit, but probably not as much as JEPI. So there's differences there. Even though JEPI has a higher yield, Verizon might be a little bit lower risk. That's what I would assume. The film host says, Joseph Carlson, have you ever heard of FAMA/French factor models? It seems to me that one of the reasons dividend stocks tend to outperform in the long run, 30 years plus, is because they are value stocks. Would you ever consider including small cap value indexes in your portfolio if these have historically outperformed due to the risk premium? Yes, I would consider it. That's probably an area of the market that I definitely don't have enough exposure to it because I have no exposure to it. So I would consider, in fact, I was looking at some funds. I think it was Dr. Doge or Dr. Ethereum or whatever he changes his name to all the time. He keeps mentioning a value fund that looks very interesting. They just don't provide any cash flow or any yield. So that's kind of the downside, is the little small cap ones usually they're not paying out dividends or anything like that. But that would be something I'd consider. I don't think it's a bad idea to invest in it. Jay Fullen says, Joseph, what do you think of the impact of AT&T's dividend cut? Will the cut require some ETFs to remove T from their holdings? Of course it will. Yes, it changes a lot of things. Do you think extra selling pressure will drop the stock price, or will it be balanced out by the positive news of debt reduction? Well, we can already see how that played out. When that happened, by the way, I was thinking about this, and I knew I had to act relatively fast with this AT&T news. It was time sensitive. This was huge news. And I kept thinking, okay, how are investors going to view this? Is this stock going to go up as a result? Is AT&T more valuable as a result? The answer to me was no. I did not believe the stock was going to go up as a result of this. I just couldn't imagine the average AT&T investor saying, oh, good, they're cutting my dividend in half. Oh, good, they're selling off HBO Max. Exciting, they're getting rid of the best part of the business, HBO Max and Warner Media, and then they're also cutting the dividend in half. I'm thrilled about this, right? There's some that are doing that. They're kind of trying to pump it on Seeking Alpha in different articles, but I just had in the back of my head, there's no way that people are going to like this news. It is not, and they sold Warner Media, they're reducing debt, but it's still, I don't know. I just had a strong feeling that the majority of AT&T investors would not like this news, and as a result, the risk reward of holding on to the stock was very lopsided to the negative. I thought there was a much higher chance that AT&T would fall than it would rise up on this news, and I was perplexed by the 4% raise in it, because I heard about the news of the dividend cut, and I'm going, there's no way that this is common knowledge. Like, as soon as this becomes common knowledge that the dividend is cut, people are going to head for the exit. So that was kind of the deal with AT&T. Looking at all the situation, they raised some of the reasons that people are holding it. I do not think the debt reduction balances it out. And I thought it was very similar to the Dominion Energy selling off their cash flow assets to Buffett. Very similar, where they reduced debt, they improved their balance sheet, but they also lowered their free cash flow. They sold off a good asset. In my opinion, AT&T sold off a much better asset than what Dominion Energy sold off, right? In comparison, like Warner Media is a crown jewel of media. It is incredible. And AT&T just got rid of it. Like they're trying to pawn it off, right? It's just frustrating. I'm frustrated by the entire deal. I didn't like the deal. I don't see any upside to it. I don't know what the problem was with AT&T just holding on to Warner Media. It wasn't hurting anything. It was providing so much cash flow to them. So, but they have their plans. They have their different opinions. Now they say they're going to be competitive in 5G. They're going to be able to do the infrastructure and investments that they want. So AT&T does have some hope. I think it might return back up in price. But when I put in that notification, I wanted to make sure everybody got a notification. So I sent one out on the Patreon where everybody gets an email notification. And I also did an alert on Discord saying I'm selling completely out of it because I think, for these reasons, XYZ. So that's why I did it. I didn't think it was a good deal for AT&T. I thought it was a pretty crummy for a lot of reasons, especially them going on TV and ensuring the shareholder just a month prior that the dividend was fine and it wasn't causing any problems and they intend to keep it. And then a month later announcing that they're slashing it in half. So not exactly something that I was a fan of there. The future of AT&T, it will be a better telecom company. So just as a pure play telecom, but if you're going with pure play telecom, you may as well go with Verizon or T-Mobile, right? If you want to just own that, I think Verizon's probably a better option, or T-Mobile. So yeah, there just was no upside in this for me with AT&T. Nothing that I liked about it. And my actions, I think, accurately represent that. Liquidum says, in your talks with M1 guys, do you know if they have the intention of expanding to the UK and Europe? Not right now. They're not expanding to, not anytime soon. I don't want to give the wrong impression. I do not think that M1 is going to be in the UK or Europe within the next 2 years. So it's just not on the radar. They're such a small brokerage, even in the US. They have so much to cover in the US. They're not even close to being in Europe yet. Hythor says, may you do your clubhouses in a time that's also friendly for EU folks between 10 and 2 p.m. Would be nice range. That's not too disruptive for us or US folks things in advance. Yes, I need to be more sensitive about that, because the clubhouses I can do, if I do them on a weekday, I have to keep that in mind, the time to do it, because I usually am doing it on the evening because, well, the kids are in bed, family's cooled down, and I just have free time to be able to do it. But 10 to 2 p.m., I can do it sometime within that. I'll try to do that next time. Thank you for the reminder. I'll do a couple more questions. Let's see, we've gone on for 20 minutes here. Reed says, I noticed a while back that Realty Income Corp and REITs were the most invested industry. Just wondering, were your most invested industry? Okay. Just wondering why you reduced that and did more tech. I'm guessing you're bullish on tech and they pay dividends and you believe that there's more growth in it than investing in REITs. Part of the reason was that the reason I was putting 20% into real estate and REITs is I just was under the assumption it was like stable and it was a defensive play. Oh, this is just real estate. I own buildings. They just pay me cash flow, right? I don't have to worry about, I don't have to worry about them like losing significant value in a very short amount of time. And what was proven in 2020 was kind of the opposite. All the technology firms turned out to be the more stable ones, and real estate, industrials, real estate, all the things that were considered to be safe investments and conservative ones, all the capital intensive businesses of real estates, industrials, utilities, like, I don't know, retail companies, all those type of companies, they're the ones that got trashed in 2020. The technology companies did great. And I know you're saying just because in 2020 it was unique, it probably won't happen the same way. That's true. But I think that balance sheet and flexibility is important. And so now the way that I actually look at the risk of a company is not so much by the traditional, like, the volatility previously or what's happened in the past. I look at it by how strong the balance sheet and how flexible of a company this company is. The tech companies have incredibly strong balance sheets. Like every big tech company has an A+ rating on Morningstar for their financial strength, meaning they can go years without even like having new money. A lot of them have no debt. A lot of tech companies they're very minimal debt. They're not levered. And so they actually have more conservative balance sheets than a lot of these so-called conservative companies. A lot of the companies that have physical assets have tons of debt. So if anything goes wrong with their revenue stream for any amount of time, they're in trouble and they have to raise more and more debt as time goes on, which puts them in even a worse situation. Look at how levered AMC is right now. They're incredibly levered. Technology companies, they're not incredibly levered. And they have very, very flexible, resilient income streams. So a lot of the tech companies that seem to be all risky were the ones that weren't risky. And a lot of the companies that seem to be conservative turned out to not be so conservative. They actually were the ones that had a lot of risk and were going through a lot of problems and were causing a lot of their investors grief. So I've kind of just changed the way that I viewed risk management. And I realized that I don't want to have that big of a portion to REITs. I just want to have a smaller portion to it. Now, I've sold out of some of them. I invested in Realty Income Corp because I think they're one of the better ones in that. I still have Realty Income Corp. I haven't sold any of that as well. But yeah, there's a lot of reasons that I switched over to having the majority of my portfolio be different technology companies, or at least companies that are enabled by it. And I focused more on strength of balance sheet and flexibility of the company. It's just for those reasons. I think that it's a safer way to invest. Hello, Joseph. Just a question regarding the latest move with SCHD. Why did you choose this one compared to VYM? And why a dividend stock rather than a value stock like VTV or SCHV? SCHD, I think, is just one of the more well put together and more well thought out ETFs. It's also backed by Schwab, right? These ones are great, backed by Vanguard. But Schwab is fantastic. And SCHD is also one that Schwab feels confident enough that they place a lot of people in automatically. Like they'll put a lot of their clients in because they think it's one of their best ETFs. So I just really think it's a very fundamentally sound ETF ran by very experienced, good people at a very reputable firm. And so if I have people copying me and going into a ETF that I'm picking out, I feel fine having them copying me and going into SCHD, right? I think that will do them well over long periods of time. So that's part of the reason that I chose it. Another part is that I do like the way specifically that they, that they weight everything. They put every sector 25% hard limit, every stock a 4 or 5% hard limit. They look at profitability metrics of the company, and they look at the yield. I just like the way that they completely do their methodology for it and how they try to keep the companies with low turnover. They don't try to swap them out for whatever newest hot dividend company comes in. They try to keep the ones that they currently have. They favor those ones. So just all in all, I think it's very solid, but no guarantees it's going to perform the best. We can't see the future here. I just think that all of these are good. I think SCHD is one that I feel very comfortable investing in. I'll do a couple more. Lino says, Joseph, I've made Salesforce my biggest position and I'm very bullish for the long term. Since the Slack deal has gone through and the stock price really does nothing, when do you expect Salesforce stock to move above the 250 range? I can't do these short-term predictions, but what I can tell you, a company like Salesforce, its value, its market cap will be tied to its top line revenue over long periods of time. So Salesforce, in my opinion, I think it will grow its revenue steadily for the long-term future. This is a long-term growth story. And I think that as the top line revenue moves further and further up, I think the stock price has to follow. Because there's companies that have less stable forms of revenue, less sticky forms of revenue that don't make as much revenue, and their people are paying more for them, which doesn't make sense. So Salesforce is one. I think the problem is not a lot of people know about Salesforce or how it works. They don't realize how powerful it is, how sticky its problem is, or its product is. People talk about like Palantir all day long, right? All the content, because I think it's a cool company. Salesforce might not be as cool, but they have 150,000 companies in the US using it. And it's incredibly sticky. Once a company signs up for Salesforce, like people talk about Palantir's product, and I'm sure that's a sticky one as well, but Salesforce is an incredibly sticky product. So I just think it has a really big moat. I think that it will continue to grow. It has pricing power. It has high margins. It has the ability to do the kind of Microsoft thing where if they ever have a smaller competitor, they can just build out their products or acquire them. And so, yeah, in my opinion, it's just a matter of time. I can't say when, but it's just a matter of time. They're going to grow their revenue. And as their revenue grows, investors will pay attention. Right now, there's a lot of short-term stuff that you can't take into account for the short-term stock price. You have fears of inflation and interest rates hikes, right? And that hurts the growth stocks like Salesforce. So all that nonsense and that what would you call it? All this noise in the background might harm a stock like Salesforce in the short term. Over time, the revenue growth will be what really brings the stock price with it. So I would just wait for that. But that's all I'm going to do. That's all I'm going to be doing for this episode. I hope you guys enjoy the little video update. I'll try to have more content out this weekend. So I'll try to have another video out this weekend. I hope you guys have enjoyed the previous ones. I've had fun making them, and I appreciate all of you for the support. So thanks for being a Patreon. Thanks for supporting the channel. I wouldn't be able to do all this without you. And yeah, I'll talk to you on the Discord.